So this unit, we're going to look at inflation. I know we looked at inflation already a couple of times. In this one, though, we're going to take the time to really look at how inflation operates within the markets in terms of what's causing it. And then we'll look at a couple of theories on inflation and then take a really, really detailed look at Phillips curve. So we want to start with just kind of basic, simple reminder. So inflation is an increase in the price level. Remember, inflation is not, and this is where a lot of people get confused, inflation is not an increase in the supply of money. That's a cause. Rather, inflation is an increase in the price level. And so we recognize it in the market every day as prices rise over time. And often we attribute inflation to a rise in the money supply. I'll give you a theory contrary to that. But that's the most often case, is it's attributed to a rise in the money supply. Deflation, on the other hand, is a decrease in the price level. We recognize it in the market when prices fall. To give you an example, a good example here is gas prices, which we notice when they fall. A lot of other items we may not notice when their price falls, but we notice when a gallon of gas has fallen in terms of price. I mean, that's a lot more of an easy one to try to picture, that rise and fall in prices. Deflation is primarily the result of a decline in the money supply. Now, over time, prices have risen steadily across the globe, with declines taking place more along in the short term. It's not like we've seen anywhere in which we've seen this long-term fall in prices just over a lengthy amount of time. Rather, it's been within this short time, couple of years here, there, and then prices begin to rise again. Now, inflation can be seen in both the short term and the long term. Deflation is primarily seen in the short term because any country experiencing deflation in the long term will purposely use policies to inflate the currency. So I've got up here too much inflation or deflation. And so we want to question, of course, can you have too much of either one of them? Well, we'll look at examples to kind of get that idea. So first, let's talk about deflation. In 1886 through 1896, prices in the United States fell by about 23%. This was a time period, of course, in which we operated under representative money. And what was taking place, of course, is the amount of money in the economy was based on the amount of gold that was being held in reserves. Well, what happened during this time period of 1880 to 1896 is gold was being purchased. When gold is being purchased, it's being removed from the markets. And so the number, or the amount of money in the economy, the amount of banknotes representing gold in the economy fell. In other words, deflation occurred within the economy because people were purchasing gold. And so the money supply is going down. It's falling. Prices are falling. Farmers are unable to pay off the debts from the low prices. And so they demand that the government purchase silver to inflate the currency. So you think about that time period there, is you've got, from a farming perspective, is the price of your farm goods is continuously going down to the point that you can't sell them at a high enough price to be able to pay off your debts. And it's even causing you to go into debt because you're not making enough. And so you want the government to inflate the currency. Well, the problem with inflating the currency is that the government just can't produce gold. It's just impossible, of course. So if there's not gold that can be used and pushed into reserves, then what they want the government to do is to purchase silver. And purchasing silver would then inflate the currency and help to generate more supply, the larger supply of money in the economy. Now, an inflation example, we'll look 1923 Germany. So at the end of World War I, Germany's ordered to pay $32.5 billion in reparations payments. In other words, when World War I ended, they signed a treaty, the Treaty of Versailles. Within the treaty, they accepted blame for the war and were forced to pay reparations, which in other words are just payments in order to say, here, we've screwed up and here's money to fix things, in the neighborhood of $32.5 billion. Now, in 1923, Germany began printing money to pay that debt off. So rather than be in a position where they just simply don't have that money to pay it, they just started printing it. Here, you want your money? We'll just pay it here. So they start printing all of this money off. And as a result, you can see what happens. As you look at 1918 through 1920, 21, 22, you start to see inflation increasing in Germany. And then in 1923, inflation doesn't just occur in Germany. We have what we call hyperinflation taking place. And hyperinflation is a situation in which the inflation rates are just moving at such an enormous speed, because you can see here the Germany value of one gold mark in paper marks. So remember from a gold perspective. So one gold mark in paper marks in 1923, you can see how the price ended up going: 10,000, 100,000. You see a million, 10 million, 100 million, and you see how that ends up going. We're talking about over $1 trillion. That's how hyperinflated Germany's currency became. And the result of this, of course, is that we see that too much money in either direction is damaging to the economy. So if we move too much into inflation or we move too much into deflation, it damages our economy. So that's why you see that there's a kind of an in-between place where you can inflate the currency and actually see success. You can deflate the currency and see some success. But if you move too far in either direction, you start to see serious implications take place within the markets. We'll look at the importance of statistics here. We've done a huge amount of statistics in this class, looking at all the different numbers, and that's important. The numbers themselves are what provides us the evidence that proves what we're talking about, and that's extremely important within the economics, is you always have to be able to provide evidence. So when you're talking about policy-wise from a fiscal standpoint, where you want to do this, or we want to do this, whatever you want to do, you have to be able to back it up by using statistics that show what's been taking place in the market and what you expect to happen. So there's three important measurements we use: the GDP deflator, which measures the difference between nominal and real GDP; CPI, which measures the price levels in the economy; and then the inflation rate, which shows the change in CPI annually. So these three measurements are what allow us to really kind of focus and pay attention to what's taking place within the inflation rates. And so these help to understand what has occurred, what is occurring, and what is going to occur. When we look at inflation rates and we look at them over time, what we see very clearly, of course, is inflation rates are increasing and decreasing in the short term. But in the long term, we know that inflation rates over the long term are going to rise, because we know that aggregate demand is always going to be, over time, shifting to the right. In other words, we know that inflation is inevitable. We know that there's a certain amount of inflation that should take place within the economy on every given year. And we can actually go in and use past numbers to get an idea of what that expected inflation rate should be going into the next year. It also allows us, of course, to look at what's happening right now and immediately. We can look immediately at CPI, and we can see on a month-to-month basis, are we showing an increase in prices? Are we moving up and down? Is it deflating? We're able to see a lot of information. And then we can look at what's going to occur. If we look at past trends over time and see where we're at, it gives us an idea as to what's taking place. Obviously, by looking at the business cycle and the trend line, we know that over time, that America is going to see increases in real GDP, increases in productivity. But we also know that they're going to see increases within inflation, within price levels. The question, of course, when we're looking at real GDP is, do we see larger increases in the inflation rates, or do we see larger increases in productivity? Because we know that every single year we're going to have some percentage of those two is going to be affecting real GDP and nominal GDP. It's a given. The question is, which is it? Are we seeing, let's say, 70% of our increases this year are because of inflation and 30% are because of increases in productivity? Because that's not good. On the other hand, if we see 70% is as a result of productivity and 30% is inflation, well, then that is good. So what policies have been, are being, and will need to be implemented? Those policies are based on the numbers that we can provide. So when we look here and we say, okay, in 1970 to 79, the average annual inflation rate was 6.72%. CPI measures show that during that time, prices increased 87.13%. So from 1970 to 1979, prices increased in the United States 87.13%. So the question, of course, would be why? Why are prices increasing like that? When we look at the inflation rate, we can get an idea real quickly what's happening. So we see between 1970 and 72 that inflation rates fell. Well, we know in August of 1971 that Nixon's administration pulled us off the gold standard and switched us over to the fiat money. And we see the immediate result of that. From 72 to 74, we see a significant increase in inflation. We're going from below 4% up to over 10% within inflation. We're talking about 7% in 1 year. So you can see the average annual inflation rate. Look at that. Year to year, in 1970s, we saw a 6.72% increase in inflation. In a year, prices went up that much. Over the decade, prices went up over 87%. At the same time, this is a time period in which we had stagflation occurring as well. So we had inflation taking place within the economy, but we also had a fall in real GDP. So between those two issues, we can get an idea of why prices were so significant then and why we saw such a large change. So there was a rise in price levels, stagnating real GDP. So these are issues that we're dealing with in the 1970s that at that point the government and economists hadn't really seen much, was an adverse shock supply. So and we look at 1960 to 69, at the average annual inflation rate the decade before was 2.12%. And CPI showed a price level increase of 24%. So during the 1960s, prices increased by 24%. During the 1970s, prices increased by over 87%. Look at the inflation rate here. It does look pretty steep when we talk about 65 to 70, but in reality, we're going from 65 to 70, we're going from a little under 2% to under 6%, so 4% change right there. And that's over that 5-year time period, as opposed to when we saw literally in 1 year a 7% increase in the decade after. So there was a big difference between the 1960s and the 1970s, and the two primary factors involved in the 60s and 70s, and the difference is stagflation and the change from representative money to fiat money. Those are important things that we need to be able to look at. We could take it a step farther. We could jump back farther in history and look at the Depression. So during the Depression, prices fell by an average of minus 1.6 annually. So during the Great Depression, prices fell 1.6% on it every year. So we're seeing deflation on a continual basis here. And by 1929 to 1941, CPI decreased by 14%. So we know that over that time period, prices fell by a total of 14%. So when we look at the inflation rate, you can see pretty clearly. You look at 1929, and then you look at the collapse all the way down to 10%, and then it shoots up under Franklin Delano Roosevelt's New Deal program because of the fact that they're using, like we said earlier, demand, the demand side economic system in which they are shifting aggregate demand to the right by pushing huge amounts of money into the economy through federal spending. And we see the effect right here. We know that Roosevelt was pushing huge amounts of money into the economy in an attempt to inflate it because we can see the rate. It's right there. And so that gives us an idea of what's taking place. Now, from a total standpoint over time, since 1913, annual inflation rates in the United States are about 3.22%. So every year prices rise on average over 3%. Now, total, since 1913, prices have risen a total of 2251%. So 2,251% prices have risen. To put it in perspective, you can think about it today. $1 in 1913 has the same buying power as basically $22.96 today. That's to give you an idea of how prices have increased. You can think about it from the perspective of a loaf of bread that cost $1, costing you $22.96. It's not like the loaf of bread has been that much of a change since 1913 to 2016. There's not been a huge change there. Rather, and that's the thing here, is that we didn't see a change in the product. Therefore, the value of the product necessarily didn't change. What we saw was an increase in prices. What you pay for that product has increased significantly from $1 in 1913 to $22.96. Okay, so why does inflation occur? We're going to look at two things here that happen, two reasons why we see inflation. The first is called demand pull inflation. So inflation resulting from increased aggregate demand is called demand pull inflation. So whenever inflation is a result of increasing aggregate demand, this is something we're used to seeing. In fact, if you look at the Federal Reserve and you look at the use of discount rates, whenever they make changes to the discount rates, they're doing this and it's creating an increase or a decrease in aggregate demand. So we know the Fed has the ability to generate inflation through discount rates which are the rates, of course, they give on banks to the banks for loans, and that's called demand pull inflation. So it's a rightward shift in the aggregate demand curve. It pulls the price levels up. And so you see here, if we look at supply and we look at long run supply, and then we put demand in here. So you can see where we're at right now with our current price level being at about, let's say, 145 and our real GDP at 6 trillion. Now what happens, of course, is aggregate demand shifts out to here. So when aggregate demand makes a slide to the right, you'll notice the price level went from 145 to 155. So our price level increased. In other words, aggregate demand pulled price levels up by shifting to the right. And that's what that demand pull inflation is whenever we see the rightward shift in aggregate demand, it's going to pull price levels up. Now, one of the things we notice about this, you can see right here, is that in pulling prices up, we also temporarily see that increase in real GDP. We see above full equilibrium employment in this situation. So a rightward shift in aggregate demand causes us to go above the natural rate of unemployment. It creates jobs, i.e. Phillips curve. So we see that increase in price levels. Now, for example, stimulus plans and increased federal spending in the short run cause this to occur. Now, we also know, of course, that discount rates, when those change, for example, if the discount rate on banks is reduced, that encourages banks to borrow more money. If banks are borrowing more money, then they're generating more money in the economy through fractional reserve banking. So we know that if the Fed wants to create demand pull inflation, the Federal Reserve can reduce discount rates. We also know that if the government provides a stimulus plan like they did in 2008, 2009, we see a rightward shift in aggregate demand. Whenever federal spending increases in the short run, we see a shift to the right in aggregate demand and demand pull inflation occurring. Now, the other way inflation is generated is through cost push inflation. So this is inflation resulting from decreased aggregate supply. So whenever we see a shift in aggregate supply here, we're talking about, of course, is a situation creating inflation or deflation. In this case, of course, whenever we see cost push inflation, what we're seeing is a leftward shift in short-run aggregate supply, and that pushes up the price level. So when we look here and we add in our supply line, we can see that right now our price line is about 145 for our price levels. So when we shift aggregate supply, here's what you'll notice. Price levels have been pushed upward. Now, unlike when we look at demand pull, what we see here is that price levels increase, real GDP falls. In other words, cost push inflation is an adverse shock in the supply. This is stagflation, and this is, from an economic standpoint, this is a really serious issue because of how we attempt to deal with it, because from an economic standpoint, we're so used to dealing with changes in aggregate demand, because that's typically what happens. Shifts in aggregate supply don't occur all that much, simply because to think about a fall in somebody's real GDP means that they had a fall in productivity levels. So what could cause that, perhaps? Well, one, a natural disaster. If you had a natural disaster in this country that, say, destroyed a good percentage of, let's say, West Coast transportation, that could cause an adverse shock because the short-run supply would fall to the left because it would reduce our productivity just in terms of think factors of production. You know, the ability to transport goods, people dying, all these different things that could cause this. But it's not often that we see shifts left in aggregate supply, but when they do occur, notice what happens. Price levels get pushed up. But at the same time, real GDP falls, and thus we see inflation plus unemployment, thus violation of what we look at as Phillips curve. So increased cost of production cause cost push inflation. Let's say a hurricane were to hit Caribbeans and destroyed something. Maybe it destroyed the sugarcane crops. Would that cause products using sugarcane to increase in cost of production? Yeah. If we had an extremely harsh winter that destroyed grasslands in the Midwest, could that possibly kill off some of the cattle and cause increased prices? Yeah, those are things that happen that we see creating cost push inflation. Let's look at the impact of inflation. So some inflation is expected in the economy. We know that because if we just look from 1913 to the present, we see that inflation has risen on average 3.22%. So price levels have increased by just over 3%, almost 3.25% every year since 1913 on average. Why? Part of that's fractional reserve banking. The banking system itself lends itself to the creation of the money supply and inflation. We know that because of the reserve requirements and the ratio with the money multiplier. A reserve requirement of 25% causes us to have a money multiplier of 1/4. So for every dollar that goes in, $4 comes out. So if we deposit $1,000 in the bank, a money multiplier of 1/4 is going to generate $4,000 in the money supply. As a result, we see an increase in the money supply, thus an increase in prices. That's where fractional reserve becomes a part of this creating inflation in the economy. Another issue here is more significant increases taking place in inflation can be generated from regional and global conflict. In other words, if you go back and look at it, all the years in which the United States has been basically in some sort of peacetime in which troops weren't operating somewhere, it's only been like 26 years of our entire history where we haven't had troops operating in some region of the world. So in other words, we always can look at federal spending and see that if we see an impending regional or global conflict occurring, it's going to create an increase in federal spending. So 1990 into 1991, the Soviet Union has fallen, the Cold War has ended, the Middle East has been destabilized, and Iraq invades Kuwait to try and gain access to its gold and oil. In doing so, the United States and many other countries sent troops into the region and pushed the Iraqis out. That created an increase in federal spending. And so we can see that if today there was something to take place in the Middle East that destabilized the region in an area where the United States has a vested interest, you would see an increase in federal spending from the United States as we shift troops and other supplies into that area because it's going to be expensive. So those types of things cause us to rise above the expected inflation rate that we see every year, which on average has been 3.22%. So if in one year it was say 6 or 7%, like it was in the 1970s, we can look and find a reason for why that's the case. Now, periods of inflation have usually been balanced by periods of deflation. When you look here, you can see the periods in red following the periods in purple where we see inflation and then we see that decline. Now, the problem is here, between 1955 and 2008, there were no periods of deflation. In fact, even in 2008, the period of deflation was not very long. You can't even see it on this chart here, but it's there because when you look here, you'll see there in 1920, 23, and then again in the Depression, second time in the Depression, and then in the late 1940s, and then right there in 1955, and then since then up till 2008, when it just barely dropped below zero, we didn't have periods of deflation. You know, we had inflation to some extent. Even if the inflation rate was 5 and then went to 3%, we still have had an increase in inflation. So that should tell you something about spending. And look at it this way. As a result, inflation rates have risen an average of, look at this, 3.78% per year since 1955. So between 1913 and today, average price levels have increased 3.22% per year. But since 1955, that average has increased to 3.78%. Now, before that, the annual deflation rates were about 2.42%. So that's the problem. That's why we get that 3.22%, because before 1955, average price level increases were only 2.42% per year. Okay, so let's look at this expected inflation. So fractional reserve banking guarantees inflation will occur in the economy, and it's managed and taken into account. And we know that because we know what the reserve requirement is, so therefore we know what the money multiplier is. So we know that for every dollar that goes in, we know exactly how many dollars are going to be generated. If the reserve requirement is 20%, well, that's 1/5. So we know that for every dollar that goes in, 5 is going to come out. So we can kind of get an estimate of what the inflation rate should look like over the course of the year. Now, it can get a little bit more difficult if banks are holding above the reserve requirement, if they hold excess reserves. But for the most part, we can have a pretty good idea of where we're going to be at with inflation over the given year because we can look at the past and then we can look at what's fractional reserve banking and what the reserve requirements are. So we know that we would assume that we would see a 3.22% increase in inflation on average. Of course, we also know that since 1955, that number's been above that at 3.77. So we can use this type of information to index for inflation, let's say wages, for example. So if we know that over the next year, wages are going to increase 3%, then that would equal, of course, what we're going to see with our inflation rate increasing. Therefore, the wage would increase by the same amount as the inflation is expected to increase, and therefore your standard of living wouldn't improve, but it also would not change. So wages adjusted to take increases in price into account. That's what happens when you talk about these stepped wages over the course of years that can be negotiated out. So for example, if the inflation is expected to rise 3% next year, which it is, and you receive a wage increase of 4%, then you would expect a real wage increase of 1%. So you can see how this works. If your wage increase is a higher percentage than the inflation rate, then you're actually seeing a real wage increase of 1%. Because that's how much extra money you're actually going to have. If it's 3% and the wage increase is 3%, then you're even. You're not doing anything because all you are is maintaining your standard of living. You're not actually seeing an increase in pay. On the other hand, if it's 4% and then an increase in 3% of inflation, then you're actually seeing a 1% increase in wages because now you have a little bit extra money. So a 4% wage increase minus a 3% inflation increase gives you that 1% real wage. Now, if suppose inflation only rises 2%, then you would have received a real wage increase of 2% instead of 1%. So you can see how this works. If inflation rose 5% instead of 3%, though, you would receive a real wage increase of -1. So if inflation rises above the expected inflation rate and it rises above your percentage pay increase, then you're actually going to have less money. Therefore, it's important to understand the difference between nominal and real wages, because when we talk about a real wage, if your real wage is increasing, then you're seeing an increase in standard of living. But if you break that down and your real wage is actually declining because your nominal wage, it doesn't increase as much as the inflation rate, well, then you're actually having a decrease in the standard of living. And if you want to talk about looking at different income levels, if you look at that lowest income level working off minimum wage, we can see right now that when we talk about minimum wage on a year-to-year basis, there aren't increases usually within minimum wage. So if a minimum wage doesn't change from year to year, but inflation does, then that means that that minimum wage is becoming less and less valuable. In other words, people working on minimum wage are seeing a decrease in their standard of living on a year-to-year basis. So the problem in the country is the unexpected inflation that occurs. We can adjust for expected inflation because we know what those reserve requirements are going to look like. We know what the average rates are. It's the unexpected inflation that occurs from some event or something that becomes the problem because it pushes those levels above that real wage. So predicting future price increases is difficult because inflation has become less predictable. You know, if for example, let's say that the United States decides to push a stimulus plan into the economy, several $100 million. Well, that would create inflation above that expected rate. So there we see that moving above. And those are the kind of things that happen. So let's talk about this unexpected inflation. So businesses' inability to predict future prices increases, causing the following problems. So here's what you have to think, okay? Businesses cannot predict future prices. They cannot count on these future price increases, and that causes some problems. One is a reduction in production due to an inability to set long-term cost of production. A business operates on a plan over a number of years, and so if businesses plan out and say, okay, we plan on producing X amount over the next 5 years, then that's what their cost of production are going to be set at within their budgets. Now, if prices increase over time, what happens, of course, is when they get to, say, year 4 or year 5, all of a sudden now they cannot purchase enough in production inputs to be able to maintain production, and thus you see a reduction in their production ability. So you see these types of things. You also see a reduction in investment because the cost of production are unstable. What happens, of course, is you've got this investment. Well, this is what we're going to invest. This is how much money we're going to put into our cost of what we're going to do. The thing about investment in production is we know that companies cannot invest and produce and spend on production at the same time because they have limits on their income, their budgets. So if we're going to deal with a constant concern of having to increase our production costs of what we're going to pay, then that means we don't have money available to constantly be investing in and constantly be dealing, of course, with the depreciation of equipment. We need to increase our facilities. We need to buy new equipment. Those types of things they're unable to do. And so as a result, economic growth slows because companies cannot predict their long-term growth and plan for it. That's the issue here with unexpected inflation. So instead, both businesses and consumers start watching prices in the present and adjusting to them. Well, what we know about prices in the present is they're slow to change. So if consumers and businesses are watching these prices and trying to adjust to what's taking place in the present, they're not actually seeing what's really going to happen. Okay, so now we're going to look at inflationary theory. What we're going to look at is why inflation occurs. And so there's two primary theories of inflation. Quantity theory of money, which you'll figure out real quick. I've been teaching you this whole time anyway, which sometimes is called a classical theory of money. And it's the emphasis on the value of money rather than the value of goods. And then the second is a newer theory called monetarism. And it theorizes that changes in the money supply do not affect real variables. And we'll talk about what all that means. So the quantity theory of money explains the long-run determinants of price level inflation rate. And there's an emphasis on the value of money rather than the value of goods. So in other words, the value of goods isn't changing. You know, if you look at the value of the good from day 1 to day 365, the value of the good itself hasn't changed. It's rather the value of the money has. And that's where this quantity theory of money really focuses on. So goods themselves do not really change, and thus their value does not really change. A loaf of bread is just as valuable today as it's going to be tomorrow. Rather, it's the value of money. In other words, a loaf of bread can be valued at one price today and have the exact same value tomorrow, but the price can change. Why can the price change? Because the value of money changes. So, excuse me. So when price levels rise, it's the result of a fall in the value of money. And so we cannot purchase as much with it as previously. So it's kind of a really easy thing to look at and say, okay, the more money there is in the economy, the less valuable it is becoming. When the money becomes less valuable, prices increase because now we cannot purchase as much as we could. So when price levels fall, it's the result of a rise in the value of money. So if we take money out of the economy, now there's less money in the supply. Now it becomes more valuable, and those price levels fall because now we can buy more with that dollar. So whenever we can buy less with the dollar, we're seeing inflation. Whenever we can buy more with a dollar, we're seeing deflation. So the supply and demand for currency now becomes an important part. Since money has a value, we know there's a market for it. And the supply of money is controlled by the Federal Reserve through open market operations, which is the buying and selling of bonds, reserve requirements, which we know they put on the banks and create the fractional reserve banking system, and then discount rates, which are the interest rates that banks are charged for borrowing money. So these three things allow the Fed to control the supply of money. So we know where that is. Now, the demand for money reflects how much wealth people want to hold in liquid form. In other words, we have all of this wealth in the country. Currency is the most liquid form of that wealth because it's immediately being used to buy goods. So how much are we holding in liquid form? The other could be in terms of CDs, mutual funds, houses, any sort of wealth that is non-currency related, that we actually have wealth in, art, for example. But how much money, how much actual cash flow is there in liquid form? So liquidity refers to how quickly an asset can become money. We've looked at this. You know, at the very end, housing is the least liquid item we have because of how long it can take us to actually sell them. Okay, two of the most important determinants of the demand for money are interest rates. When we look here, we can see what's happening. Rising interest rates decrease the demand for money because they increase the cost of buying financial capital. So when we go from 2% to 4% on the interest rate, notice that we see a decline in the quantity of money demanded because of the fact that now it becomes more expensive to buy. So falling interest rates increase the demand for money because they reduce the cost of buying financial capital. So if the interest rates are at 4% and they fall to 2.2%, then the demand for financial capital increases from 5.5 million to 8 million. So we can look at the different points along the line there and see that as interest rates are changing, we see a change in the quantity demanded of money. The other is the average level of prices in the economy. People hold money because it's the medium of exchange. So the amount of money people choose to hold depends on the price of goods and services. In other words, people will spend money when prices are lower, and they will hold money when prices are increasing. And this plays an important part because we know that even though inflation is an increase in price levels, So we know that, but here's the thing. This is what we kind of look at. We know that even though inflation is an increase in the price levels, we know that the prices themselves, the actual sticker prices, aren't going to change quickly. So we know what happens. We know if inflation is increasing in the market, we know price levels are rising, but the actual prices themselves have yet to change. Therefore, we'll spend money because the prices are low. As the prices begin to rise and the actual prices on the sticker prices begin to increase, spending, of course, is going to decrease. Now, we know that based on how we look at Phillips curve, which we continue to always constantly go back to, because when we're talking about inflation, that's really the primary graph that we always go into. So in the long run, the overall level of prices adjusts to the level at which the demand for money equals the supply. And that's what we're going to look at. So let's look at this market for money. So the quantity of money is fixed by the Fed. They determine that amount. As a result, of course, quantity fixed by the Fed is vertical. So the supply of money is vertical because they fix it. There's no changing the supply of money unless they change it. And even when they do change it, all it is a shift to the left or right of that vertical line. So in the market for money, supply is vertical for this very reason. Now, the left-hand vertical axis here is the value of money, 1 over P. So you'll see it's high, and then it drops to low. And then on the right-hand axis is the price level, which is inverted from the value, whereas 1 is low, and of course down at the bottom is high. So the higher the price level, the lower the value of money. And we know that as we look at it, we can see it here. So the demand for money is downward sloping. So we see the money demand curve there. So where demand crosses supply, point A, that's our equilibrium. So as price levels increase, people demand higher quantities of money because the value has fallen. And that's kind of the key here, is that when as the price levels are increasing, we need more money to buy goods. And that's what we're seeing. So the quantity theory of money argues that the primary cause of inflation is a growth in the money supply. Okay? So that's the argument they make. Now we can pull it up here and look at it. You get an idea. When an increase in the money supply occurs, so when we go from money supply 1 to money supply 2, we see an increase in the supply of money, which decreases the value from 1/2 to 1 over 4, and increases the price level from 2 to 4. So you see what happens. When the money supply is increased, it shifts along that demand curve to go from point A to point B, which reduces the price, reduces the value, but increases the price level. That's the quantity theory of money. That's the primary argument, is that the reason why we have inflation is because the money supply changes, and when it changes, it shifts and creates new equilibrium points along that demand curve. We've been studying this all this entire course, so that one should make very easy sense to you. It should be clear as day because you're used to hearing about it constantly. Okay, let's talk about monetarism. So monetarism theorizes that changes in the money supply do not affect real variables. Now remember, real variables and nominal variables. Nominal variables are those that we look at the current pricing. We talk about inflation adjusted. So real variables are variables measured in physical units, whereas nominal variables are measured in monetary units, i.e. how much something costs. So from an example standpoint, the income of grain farmers is a nominal variable because it's measured in dollars. It's just X. So X dollars times however many bushels of corn equals, that's how much you would make. The quantity of grain is a real variable though, because it's measured in bushels. How many bushels of grain, i.e. wheat, do we have? And what is the value of that compared to something else? So why does this matter? Prices are quoted to us as money, which makes them a nominal variable price, because what we say is that something is quoted to you as $4.99. Well, all we're really saying to you is that's its measurement. That's a measure of its value. Real variables are looked at from the perspective of relative prices, though. So the price of one thing compared to another. For example, the price of wheat is 2 bushels of corn. So which is more valuable? The wheat is. Why is the wheat more valuable? Because it costs you 2 bushels of corn to buy the bushel of wheat. Now, monetarists call changes in price, the nominal variables, irrelevant. So in other words, for monetarists, going from a price of $4.99 to $5.99 is irrelevant. And they argue that money is simply a unit of measurement. All that's doing is measuring things. It's not, has no other purpose. So Monitors argue that inflation is caused by how fast, velocity, the money supply grows or shrinks. In other words, from a monetary standpoint, money supply is still the cause of inflation, but it's not about money supply just in saying, okay, the money supply increased. No, it didn't matter to them. What matters is how fast it occurs. That's what, from a monetary standpoint, causes the inflation, is the speed, the velocity at which it grows or shrinks. So the velocity of money refers to the speed at which the typical dollar bill travels around the economy. So high rates of inflation result from the Fed increasing the money supply rapidly. In other words, if the Fed makes a sudden and swift change in the supply of money, inflation is going to occur. So it doesn't matter so much that they increased it, it's rather the speed at which it occurred. So the quantity theory of money argues that any increase in the money supply will cause inflation. Monetarists argue that only a rapid increase in the money supply will cause inflation. From their perspective, Federal Reserve in the fractional reserve banking system would not really create any inflation at all because it's something that's happening over time. On the other hand, if you turned around tomorrow and dumped $800 million into the economy, that would create inflation because of the rapid increase of the supply of money. So they're focused on velocity, speed of the increase, rather than simply an increase in the money supply. So let's look at inflation in the short run. So neither the quantity theory of money or monetarism can truly explain inflation in the short run. Neither one is completely adequate. However, the principles behind Phillips' curve do help to explain short-run inflation. And remember, long-run inflation here is not what we're worried about, because in the long run, we know that aggregate demand is going to shift to the right, and we know that in the long run, we're going to see a rise in the inflation rate. So let's look at our Phillips curve, and then we'll kind of get into a little more detail. So what we know, of course, is we have point A. Point A represents our natural rate of unemployment at 3%, and the expected inflation rate, which is 4%. So we see those in the economy. The question, of course, becomes what happens when inflation rates rise above the expected or rise or fall below the expected. So let's look at point C. When the inflation rate rises from A to C, it increases from 4 to 6%. When that happens, we see a decrease in the unemployment rate from 3 to 1%. Now, as we've said continuously, our most likely explanation for why this occurs is sticky price theory, is that the actual sticker prices on items are slow to change and reflect the true price levels that we see in the economy because of inflation. So as a result, we see more money in the economy with low prices and thus spending increases. So when inflation rises above the expected inflation rate, the unemployment rate falls below the natural rate. But here's what we're really looking at. This is where we really get into the details with Phillips' curve. The combinations of inflation and unemployment that arise in the short run. Okay, we know that there's combinations. We can see them, A, B, C, D, E, F, G. So when those combinations arise in the short run as shifts in the aggregate demand curve move the economy along the short run aggregate supply curve. So here's what this looks like. So we have AD1 where it connects with short run aggregate supply and long run aggregate supply. We know that that is our potential GDP. That is where equilibrium, that's full employment equilibrium. Now, when AD2 pops up, we see it shifted, as did AD3 and AD4. So when aggregate demand shifts along the short-run aggregate supply curve, we see the different combinations. This is combination 1, for example. So at combination 1, we see that price levels is 145 and long-range aggregate supply, short-run aggregate supply is 6 trillion. Each of the inflation and unemployment combinations that you see on here, 1, 2, 3, and 4, represent a different point on Phillips' curve. So when you saw curves for A to C, C, for example, could have been the last combination there. Could have been the middle one. But that's the thing, is that the shifts in aggregate demand, these combinations that you see here of aggregate demand and real GDP represent points along Phillips' curve. So Phillips' curve is a guide to economic policy. You can lower unemployment by expanding aggregate demand, but it costs you an increase in price levels. So from an economic standpoint, if unemployment rates are high and you want to lower them, you can do it. You have to expand aggregate demand. If you do it though, you're going to see an increase in price levels. At the same time, you can deflate price levels by contracting aggregate demand, but you must accept higher unemployment. If price levels are too high and you want to lower them, you can do it. but you're going to reduce the number of jobs. You are going to create a higher unemployment rate. So Phillips curve is able to tell us what is going to happen when we enact certain policies. So in the long run, Phillips curve is vertical because all factors of production are vertical in the long run. So you look at how Phillips curve looks in the short run. It looks like a demand curve. On the other hand, in the long run, it's vertical. Why? Because all other factors of production are vertical in the long run, and price levels don't affect them. So in the long run, unemployment and inflation are unrelated. And that's kind of the key point here, is that when we look at inflation, it does not affect employment in the long run. It does not affect unemployment rates because that is a matter of long run aggregate supply. So when Phillips curve breaks down, and we know it does, 1970s stagflation economy experience, we saw breakdowns in Phillips curve. We see an increase in price levels and a rise in unemployment. So we know that Phillips curve can break down, and we know that when stagflation occurs, what we see is a shift in Phillips curve. For example, here's the inflation rate percent per year in 1960s. You see how Phillips curve looks like what we say Phillips curve looks like. You'll notice the inflation rate during that time. We see an inflation rate we can make pretty good sense out of. It falls there from 2 down to 1, and then we see it's kind of steady and then begins to slowly increase. But now let's look at inflation rate in the 1960s into the 1970s. So you'll notice as we go 1961, 62, 63, as we move along that, you'll notice into the 70s, you see all of a sudden Phillips curve starts looking really weird. And that's because of stagflation. Notice the inflation rate, how much different it is, how much more it fluctuates. So the trade-off between inflation and unemployment are no longer favorable. So when we have stagflation experiencing in the economy, when an adverse supply shock occurs within the economy, when increased price levels and a rise in unemployment are happening at the same time, the trade-off between inflation and unemployment is no longer favorable. So when we can look at it here, inflation rate per percentage per year. So we can kind of move along these numbers in the 1970s. Look at it. This is what we see. This is stagflation. In other words, when inflation rates and unemployment rise at the same time, Phillips curve is not reliable. Therefore, we cannot count on it for economic policy. It doesn't happen that often, but you can see what happens and the impact, and you can imagine how difficult it would be from an economic policy standpoint to try to fix the economy. So Phillips curve helps to explain the short-run effects of inflation by showing the relationship between inflation and unemployment when changes in aggregate demand take place. Phillips curve breaks down when aggregate supply is suddenly shifted. That's what happened in the 70s. We saw aggregate supply shifting to the left, an adverse supply shock, and you can see the result looking at Phillips curve. So Phillips curve cannot explain long-run causes of inflation. Thus, the quantity theory of money and monetarism attempt to do that instead. So that's that thing on inflation. And when we talk about this course, inflation is one of the single biggest important things because you see it over and over and over again.